All right, welcome to Trendy Options. Today we're going to talk about risk management. This is an impromptu video, so there will be times that there may be pauses and me looking for the right words that I want to say. Anyways, welcome to week one, which I feel is probably the most important part before we even get into a trade. We must understand the risk that we are about to take on when taking a position, whether it be an equity position, an options position, a futures position, a forex position, anything in the market we have full risk on. Now we want to define our risk before we get into a trade. And I want to show you different ways we can do that by just using the platform that we have and also looking for the setup. And these are just going to be very basic, very standard risk management setups, but I think they're very important. So the blue lines on the screen are trendy edges. Those are the yearly edges, and the pink ones that you can see on the screen are the monthly edges. Because, and for this format only, I'll be using the edges as an example for risk management. Price has moved up from the edge, and you can see now price has moved down into the edge where we look to get long. When taking a position at any place in time, or let's say in this case at the edge, let's find out what the price is. We can see here over on the right hand screen, 59.78 would be our entry. Now this may seem very trivial, but I do want to go over it. Let's say that we're going to buy 1,000 shares of QRVO at the edge. 59.78 times 1,000, that would be $59,780. Okay? Now, whether you're using margin or just regular, that's up to you. But let's just pretend we're buying 1,000 shares right here at the line. Now, this may seem simple to you, but some traders don't think about this when they're buying it. Now, in most cases in trendy options, I'm only usually risking about $1.50 to maybe $2 of risk on especially stocks that are under like $100. Anything that's over, let's say, $100 to, things like Amazon and Netflix and so forth, then my stop gets a little bit wider, and we'll talk about that here a little bit, okay? But for these purposes, let's talk about QRVO. It's a $71 stock. I'm comfortable with about $2 of risk to $1.50, okay? Looking over and down and to the left, we have a zone here. Price came down into that zone, it pushed out. I'm comfortable with $1.50 to $2 risk. Let's go ahead and go $1.50 to $2 down. That would be 59.78 minus 2. That'd be 57.78. And we're going to get here, and we're going to roughly do it. That's going to be our stop, okay? Let's go ahead and we're going to make this red. And yes, I would expect everyone to put this kind of time into their setup before they get started. And we would put stop here and just annotate this, okay? So that when price is ready to come down here, so this is, we're looking at it like this. Price moves up. We want to take it when it gets back to the edge. We're also going to set an alert at or below, okay? Time to buy, right? Whatever you want to put in here. This is going to alert you by SMS. Okay, price gets there, take the trade, $2 stop, 1,000 shares. All right, now we want to know what is our risk to reward, right? And you're going to learn all this stuff as you go through your videos, but in most cases, we already have targets lined up for you, okay? So in this case, we know through our Fibonacci tutorial, which you'll get later, is we'd be shooting for the 50, roughly about right here. Okay, so let's just go ahead and take that off. And you can see here, in this case, we're risking $2 or $2,000 for an opportunity to go from 59.78 to 68.40. Let's go ahead and pull out our calculators really quick. 59.78 minus 68.4 equals $8.62. So again, folks, here, $2 risk. and $8.62. All right, so basically a 1 to 4 relationship here. So for $8, right, we're going to make 8,000, roughly $8,600, or you could lose $2,000. This risk to reward is very nice. Okay. Every time we take a trade, we risk money. You will learn at Trendy Options the most important thing is to be mechanical, to understand that we are taking higher probability trades. And because we're taking higher probability trades, we don't risk a lot of money because the probabilities of the trade working out for us are in our favor. But when they're not, we're okay with the money that we are risking. In this case, this is a little bit smaller. This is called a monthly edge. Price has moved down into the monthly edge. We look to take the trade. We look to put $1.50 to $2 of risk on here. This price here is at 68.97. So you could put your stop at 66.97. Let's go ahead and move this. And again, these are just, I can't get these things perfect. There's your stop on this case. So we're going to bring this up to here. Okay, let's do that. And we're going to erase that one. Okay, and just forget about everything that I've showed you down here. So the idea here is when you take the trade to the upside, you are risking $2 here. Okay, now let's talk about this for a minute. And you're going to learn this later on in your Trendy Edges tutorial or lesson there. So as price moves up, if I'm taking price at 68.97, I expect it to stall at this next trendy edge, which is roughly 74.96. That's about another $6, folks. So $2 to 6, that's a 1 to 3 ratio. Okay? So in this case, do we have to risk $2? No. No. But the idea is when we're taking a trade, understand what your set amount is. Now you're going to learn how to trade around these edges, and you're going to see when price does push through the edges. Typically, if it's going to hold, it's not going to break your $2 mark. Okay. So in this case, if I were to take this trade at the edge, I mean, you could see the candle here closed above. You literally could bring your stop just right underneath the edge. Okay, a little bit like this, or you could use the previous wick candle here. Okay, now here you have the higher risk of being stopped out and price coming back up and doing what you wanted it to, and then you just get frustrated. So in order to really take advantage of the best risk to reward is one, believing in your system. If you believe in your system, your stop may look wide to you, okay? But you also believe that, hey, I've seen this so many times. I have a higher probability of chance coming into the lower trendy edge and then moving up to the top. So I'm okay with keeping my stop here. Now in this case, 67.61, you can see here we tightened it up. Okay, so let's take 67.61. We're going to minus that by the edge, where we take the price at 68.97. Give me 1 second here. And you have $1.36 of risk. So in this case, you would have $1,300, $1,360 of risk. Okay, right here at our stop. And then we have the possibility of hitting the upper edge. Okay, and the upper edge, let's just call it 74.96, and you can see it there on the right-hand side. 74.96 minus the edge there at 68.97. And you can see here it's $5.99. Okay, so $5.99, or let's just call it 6,000. All right, folks. So in this case, we're looking at $1,360 risk or 6,000. All right. So every time we take a trade, we use a bracket trade. In this case, on an equity trade, if I were coming over here to active trader, okay, we know that the price is 68.97. Okay. Now let's just say we're going to buy 250 of these, or let's just do 500. There's 500 on here. 68.97. We're going to come down here to 68.97. First of all, we're going to set up our bracket. Sorry, this equity trade. Okay, trigger with bracket. We are going for, in this case, $5. Okay, and 99 cents. 5. And we are risking, I think we said $1.36. And then after you put these in, you want to hit enter just to make sure they're good. You can see here the time and frequency day. Okay. You can put the GTC on here, good till canceled. All right, so let's go over here into, we said the monthly is at 68.97. Let's find 68.97. Okay, go ahead and select. And you can see here, this sets up our trade automatically. So when this candle was here, we're able to take the trade at the monthly, 500 shares, 1,360 risk. It almost takes you out, pushes up, and currently up from there about, $3 or so, almost $3. So in this case, on 1,000 shares, almost $3,000. Now, what can you do from here? Do you have to sit here and go, hey, I'm up $3,000, what exactly can I do here? All right, I'm not going to sit here and be up 3,000 and wake up tomorrow and be down. You can trim, okay? You can also do a trailing stop on these shares, and that's pretty easy. You can come over here and you can select the stop, and you can go to cancel replace order, okay, here, and you can change the stop, okay, in here to a trail stop, and then you're going to set that all up. This is not what I'm going to show you in this tutorial, but there are different ways of doing this. We could also trim at different spots within here, and you're going to learn all this through your Fibonacci tutorial where you can trim and so forth, okay? But this is just setting up and showing you risk to reward. Now, you might have come to Trendy Options just for options, right? Everybody is very attracted to options, right? You get big returns. You see these huge returns. Your friends are telling you about 100%, 200%, 1,000%. How do we set that kind of trade up in here and understand what our risk to reward is? Well, it's the same way, folks. Okay, it's the same way. So in options, we're using what we call delta. And I'm going to kind of show you exactly what I'm talking about here, okay? Let's go over to trade for QURVO. And you're going to see that I have delta set up, okay? So what is delta? Well, basically what this means, folks, these numbers over here, all right, is how many dollars your option price will increase, but if you're in a call, okay? How much it will increase for every dollar move in the underlying stock price. So every time QRVO goes up $1, say we picked the 34, delta 34, you will hear me say that many, many times. Okay, let's pretend we're going to buy 10 of these. So instead of buying, 1,000 shares, okay, straight up, we're actually going to control 1,000 shares with 10 contracts of the delta 34. In this case, that's a $75 strike. These are going roughly, let's just say we pay for the ask at $1.55. Okay, $1.55 times 10, $1,550, right? All right. So $1,550, is that the risk that you're taking on? No. I mean, I guess if you were to hold it overnight, yes. All right, and we'll talk about that stuff a little bit later as well. So are you just doing an intraday trade? Are you risking this for a swing trade? All of those mean different things when we're talking about risk to reward. Okay. So in this case, we have $1,550, and we know that the delta is 34. Okay. So in this case, if we go back to the charts, okay, in this case, we're risking, let's just call it $1 to make this very simple. Let's say that we are risking $1. Okay, $1 risk. Meaning, after we buy QRVO, we're getting out of our option if price drops $1 from our entry at the edge. Okay? All right. Let's bring this here. That's roughly 68.93. Let's bring it down to 67.93, roughly 94. We're going to put our dollar risk here, folks. Okay? Now remember, let's go back to the trade. And you can see here, again, the delta is 34. So the question you should be asking yourself, if you buy 10 of these and we drop $1 and you get stopped out, what is the estimate of loss that you will have occurred, okay, if the price drops $1? It's very simple math, okay? In this case, we're going to say 0.34 times 10. That does not include commissions. Let's say your commissions for all of this was $10 to get in, $10 to get out. We'll add 20 to that. This is $340 plus commissions plus 20, and yours may vary, equals 360. Okay? That is your risk on 10 contracts using this setup. But what happens if we get to our target to 74.82? Let's just, again, round it off and say that it's $6 to target. Okay? Well, the estimate is that this could increase 0.34 for every dollar. And in this case, you have made $6. Okay? So again, 6 times 34 is 2.04. So $204 per contract. Remember, we bought 10 of them. Okay, times 10. That's going to give you $2,040. Now, this is an estimate. We talk more about options and talk about Greeks and theta and delta and all that fun stuff, then we can get a better understanding that those are variables. They can change, and options are and use extrinsic time. So depending on the time, how long it takes you to get there and so forth, there's so many different variables. But the best thing that you can do is figure out what your risk is before getting in the trade. Okay, so in this case, I'm risking $360, looking for 2,040. I like my risk to reward when it comes to this. Now, I would tell you that most option traders come into the stock market with the wrong idea. They typically are putting on the ideology that it's okay, and you will hear this across the board, it's okay to let your options go to zero because you're risking what you put in. So if I put $1,000 into this trade, then it's okay if I lose this 1,000 because I paid 1,000 and I know what my risk is. Let me tell you something. If you don't have a good process, this is going to happen to you over and over and over and over until you have zero in your account. Okay? Because there are streaks even professional traders can lose weeks, months, and I've even known traders who lose almost every month for over a year. So please get out of your head that it's okay to let options go to zero. Now, there is, let's talk about this. There is the case where, let's say at Trendy Options, every trade I take costs me $1,000. But because of market conditions, I'm telling the room, hey guys, I'm not comfortable putting in my full position today. I'm going to start with a quarter of this, 250. Okay? Now, typically, when I trade $1,000 worth of options, I typically take no more than a loss of $250. But today, I am only trading with $250. This will be the only time that I allow a position to possibly, right, go to zero because my standard risk amount is 250. And today I just so happen to put my full risk into one position or two positions, whatever it may be. So I hope you can understand that. All right. So it's still good practice though, folks, not to let options go to zero. However, this is the only scenario in which I would consider this being okay. Now, when we take swing trades, we have a risk, folks. Okay. Let me just kind of show you what that risk looks like. Let's say that right here, John decided to buy 10 contracts at $1,000. Okay. And he said, you know what, guys, I think it's time for a swing. Swing trade, meaning that it's going to take multiple days before it expires. You feel good about it because, hey, I bought more time. It's got to go up, right? Well, when you hold something overnight, and this is a weekly bar by the way, these are weekly candles. Each candle represents a week. If I hold this trade and the next day it drops down, okay, $5 to $6 here, guess what? That position I was holding is down extreme. I mean extreme, right? And most traders are going to get scared out of their position, take a huge loss, and then notice, several weeks later it picks back up. All right. Now it just depends on what kind of time you're doing. But just understand that you're always taking a risk when you hold overnight. Am I discouraging you from holding overnight? No. There are going to be times in the market where holding is the best thing you can do, and there's going to be times in the market where it's the worst thing you can do. And here at Trendy Options, we help you identify those cycles in the market. Okay. But again, risk to reward is the most important thing we can do. Now, I get a lot of questions about sizing. It depends on how you want to size, folks. I mean, seriously. I mean, I know traders that have $50,000 accounts and they don't put more than $500 into a trade. It's all personal preference. It's whatever you can stomach. Now, I'll tell you, a lot of traders, they take on a lot more than they can chew. Because see, when you get into a position, you get into the position because you think the position is going up. But that's not the case, is it? We don't know which way our position's going. We really don't. We have a probability that if you're using a good process, that the position should be going in your favor, whether that be down or up, depending if you have puts or calls. So as a trader, you put on the position because you think you know the direction of the trade. But the honest truth is you don't. And that's why we need to understand our risk. There's a high probability that most new traders are not going to get this right. So you need to understand in those scenarios I showed you. I'd much rather know I could lose $360, okay, and the possibility of making $2,000 than not knowing anything at all and waking up the next day and looking at a negative $1,000. Okay? Very important. So all we can do is figure out a risk, execute the trade, manage the risk. What does manage mean? That means you know where your stops are. That means you set alerts. You know where you want your stop to be. Now let me ask you a question. When your alert goes off, do you get out or you keep praying and hoping because you think price may go back up? I could tell you here at Trendy Options, the one thing that I really, really want to send home is I've been there and done that, and the probabilities, if you have a great process, the probabilities of that trade coming back in your favor are very slim. Once you understand after you lose that amount of money, that your chances of price even coming back to getting where you first bought, they're so low. And once you can really understand that, you will no longer pull your stops. You will get out when the chart tells you to get out. Believe me, if you pull your stop or you're mad about the money you lost, what it says is that you never truly committed to that trade. Because to fully commit to that trade, you got to fully commit to losing that money. Okay? You fully have to commit. Every time I take a trade, I am 100% fully committed to losing that $250. I'm okay with that. And again, I'm using 250 just as an example here in the room. It could be bigger, could be smaller. Okay. Now, what are some other things that we can talk about with risk management? Maybe overall the size of your account, right? We could say, hey, I see all these different things out there. If you have a $10,000 account, you should risk this much. If you have a $5,000 account, you should risk this much. Personally, I don't think that you should risk anything over 2% of your account. Okay, that's just me. No more than 2%. And if you have multiple positions on, I would say no more than 5% of your account. Okay, so however that's sorted out, you might have Apple calls for 1% of your account. You might have some NVIDIA puts for 0.5% of your account, and another name you might have 2%, something like that. Okay, so but do not go over. All right. Another thing to keep into consideration is always keeping the trade around the same amount of money or same amount of contract size. Now, there are things in place here in Thinkorswim that you can actually set up, at least on OCO orders, where it goes by dollar amount. So no matter what, if you tell it to buy at a certain amount, it'll only buy as much money as you say to put in there. So or you can just do the quick math. If it's $1,000 for every trade, then that's what you're looking for. Let's get back into the options, okay? So if we go back over here to trade, now you can see why it's so important for the delta, okay? But see, a lot of new traders, they're attracted to these lower delta options. The probability of these getting in the money are so slim. And one thing that you can do over here, folks, is you can come over here. Let's change this and go to something that can really open your eyes here. Okay. Probability of in the money. Now I want you to pay attention to this. Even at a delta 30, you only have about a 30% chance that this will actually expire in the money. That's what they're saying. All right. So you have a 70% chance that this is not going to work out. Now they're just saying that it's going to expire in the money. All right. Now, so for the gamblers who pick these guys out here because they're cheap, it's like a penny stock mentality. It's like, oh, I'm going to buy 100 of these for, this amount of money, right? It's not a big deal. It's only delta 13. But the probability, folks, 11%. Let's just call it 11%. Let's call it 10%. You have a 90% chance that this is not going to expire in the money. Okay. I tend to trade a process. I try not to look at the money amount. I think about the process. Okay. The process says I have a higher probability of making money. That's why I took the trade. Okay. So I like to buy a little bit closer to at the money, and depending on the size of the stock, sometimes I'll buy in the monies. Okay, in the monies. All right. So again, I'm looking at process. I'm not looking for the cheap ride. I'm looking for the lotto. I'm here for consistent gains. Okay, consistent gains, and people will show you this. Mark Douglas talks about this. John Carter. A consistent trader makes money, and it goes like this. This is your capital, folks. Okay? Higher highs, higher lows. This is somebody that likes to pick this kind of stuff. Confidence, no confidence. Gets back, goes big, down. Gets really lucky one day, gets more confidence. This happens. Typically, these traders end at zero. It's just a matter of time. Okay? So we're looking for higher probability trades, and we're always looking at a risk to reward. Okay? So again, some of the factors that we have are delta. Then we talk about, the expiration on options, and we'll talk about that more in the option selection. We'll talk about that here soon in your next tutorial. Okay, so that was just a little sneak peek of what I want to show you getting into that. But risk to reward is so important. And if there's one thing you take away from this video, please understand what your risk is before you get into the trade. If you can fully accept that risk, trading will become something you want it to be peaceful. You don't want it to be chaotic. You don't want to be freaking out. Okay? What are some other things we could talk about? We could talk about slippage. Okay? We could talk about spreads and options, and we'll talk about that more in the option section. So there's many different risks, but I think what I want to drive home in this video is simple. Set up a bracket order on equities, know what your risk is, times it by the amount of your risk by the number of shares you have and the commission. That'll give you what your risk is. And then on the reward, we're going to show you later on the tutorial with Fibonacci's and so forth, how to find your targets. Okay. So all that good information is really going to set you up. So again, thank you so much for coming and being a part of this. If you have any further questions on risk management, please reach out to me. Okay? I'm here for you. Thank you again. Have a nice day.